please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Nifty indicating that we'll have a 244-point gap down, 10,317. 10,276, by the way, was Tuesday low. So if the SGX Nifty is right, we'll start somewhere around that mark. Ashwini Gujral, Mitesh, Thacker and Prakash Gaba now join us. Good morning, gentlemen. Ashwini, so, you're talking about this probability yesterday that maybe a multi-day short could be initiated on rallies. But the problem here is for those who did not take shorts yesterday, how to approach the market today. If we open at the low point or near Tuesday's low, what is the trade then?
Good morning, Anuj. You tried very hard at the conference to get an answer whether 4 digits will come. I'll give you in half a minute that yes, it will come.
Okay.
And obviously barbers will not advise you that you don't need a haircut. So the point here is that we are in a downtrend. Like in the uptrend, your template was each dip you have to buy. Here, each rally you have to sell. So, the markets are breaking down. So, to keep on buying each up day is a sure recipe for disaster. Now, today, you will be hitting 10,300, which is the lower end of the range, 10,300, 600. And you are coming with a 200-point gap towards that point. So I have very little doubt that that day's low of 10,276 will get taken out. And, a lot of people will be heartbroken because Wednesday is gone. So chances are there will be a waterfall decline post that. So I'm ready for that. Yesterday also we had short positions, but the market decided to give short covering. So here, if you are coming in with short positions, chances are you will get rewarded.
Okay. No, Ashwini, to be fair to those fund managers, they were not guessing a bottom. They expected volatility in this year, and obviously not a repeat of 2017 that easily. You only heard a bit of that conversation, but yes, there was that palpable fear that volatility could shake out and give us any levels. But Nifty Bank, will you trade at all?
See, again, once something is down 200, 250 points, you can't take the first gap down trade. You have to wait for a bit of a rally. And given the strength of that rally will tell you whether we are going to take this 10,275, 300 out. I think on banks also, you will make fresh lows because most markets today have broken that day's low. So my sense is that any sort of rally should be sold into even on the bank Nifty. I think 24,800 thereabouts should happen even on the bank Nifty. See, 200 is just a benchmark. Markets do trade below 200-day moving averages in corrections, and that should be expected given the momentum with which we are falling and given the global tone of this market. So we are 5 days into a correction. So if you become too overexcited, you will buy expensive and then look at lower prices. You need this momentum selling to end before you think of any kind of buying.
Sure. Okay, but Ashwini, once again coming back to the big point, for someone who has a horizon of say 6 months to 12 months or longer than that, is this going to be that big buying opportunity if this is still a bull market? I'm asking, do we go back to 11,000 at some point this year, or do you think a top for the year has already been made?
Well, this year will be a year of consolidation because last year was a trend year. So a consolidating year means that maybe you'll close at 11,300, etc. But you will have volatility, and volatility where the downside will literally shake people up, and it'll put the fear of God. People who thought there is no risk in equity and buying will come back, etc. Markets like to shake out complacency, and the way Dow and we are falling, it looks like market is in a mood to put risk on the table. So while we could get back there, but getting on it from 95, 9600 may be a much better idea rather than trying to buy at 10,300 and then get shaken out when you get into 4 digits, because the selling, the panic the screams are still to be heard.
Okay,
Yeah,
so get ready for a big ride on the downside. Let's get the other guests on board as well. Mitesh, Thakkar and Prakash Gaba are also with us. Prakash, everyone's going to be watching that 10,276 number, right? The low that we saw on Tuesday. You think that could be taken out very soon?
Certainly, it's a matter of time. See, what we have seen, there's a beautiful geometry at the high. 11,169 was the target, 11,170. There's a beautiful geometry out there. Now, if the market has to bounce back from the lows, they need to see a good geometry there. There's a very good geometry at 10,097. Will it hold there? Who knows? Maybe, maybe not. But if that geometry goes, then the lower targets perhaps are 9,800 zones. So I think it's heading there. What we have seen in the last couple of days is a good short, good expansion. Yesterday, what we saw was some kind of a contraction happened. That was a reaction that we saw. It's gone up, reactive up move. It's gone up to come down. So it looks like it's going to come down and head towards 10,097 zones. Like this was in daily time frame, but if you look at intraday time frame, do I short in the morning? Of course not. I would like to see some kind of a relief rally. That relief rally needs to be shorted for a target. Only thing is we need to increase the time frame, not today, but maybe from today to day after tomorrow, from this week to next week, and make money on the downside. So all rallies are shorting opportunities.
Okay. Well, Mitesh, good morning to you. What would your levels and your strategy be on the indices, both Nifty and Nifty Bank?
Good morning, Lata. We've been calling for a break of this level for the last few days as the market has tried to bounce back. Two things. One, V-shaped recoveries don't have any base building, so typically 9 on 10 V-shaped recoveries don't last and end up in a new bottom. Secondly, I think this entire rally or whatever pullback which happened even failed to get past the 50% correction, the decline mark. So I think very clearly a retest was definitely on the cards. A breakdown is also very possible. So the way I would approach the market today is that see where the market opens. If we start showing signals of getting below the 10,320, 330 mark, and that's the closing important low rather than 10,276 for me, then I think I would look at levels which Prakash was just talking about, 10,100, 10,097. I think it's an important pivot on the short to medium term chart. So I think that could be tested. So clearly keeping that in mind, I think would be still more inclined to take to maintain rather not to if not to initiate short position, to maintain a negative bias on the markets.
Let's talk about stocks then. Ashwini, again the same point. If we have a gap down, how to approach individual stocks? What would be the top trades?
Basically 250 points down, it's difficult to give any top trades. But stuff that's been coming off, like, something like a PC jeweler, chances are it'll again start a big downside. So that's a sell with a stop of 387, target of 370. Tata Motors DVR, again, stock that's stuttering. So that's a sell with a stop of 215, target of 200. Telecom is failing. So Bharti Airtel, that's breaking its 200-day moving average. That's a sell with a stop of 435, target of 410. And a couple of stocks, maybe if the markets do try to rally. So Biocon is a buy with a stop of 600, target of 650. And Bharat Forge is a buy with a stop of 750, target of 775.
Okay, talking about Bharat Forge, Prakash, a lot of the non-index large caps did well yesterday because of their numbers. Bharat Forge, you had Page Industries, you had Heidelberg Cement. Anything from that pocket that you like, and if not, anything else?
Well, I would say that some stocks certainly did very well, and I would say that some stocks still looks okay. I would look at India Cement here. Now, India Cement is showing signs that it can climb up. Possible target on the upside could be in the vicinity of 168, 170, even 175 zones. So far, there's a good base formation stretched on the downside, so unstretching could happen. Tata Chemical is another stock, again, from large sector, large cap here, certainly looking good. I like the base formation here as well. Very good chance we can see a climb to around 725, 730 zones if the market goes up and stop below 696. Two stocks looks weak to me, certainly. A is Kedila Healthcare. Looks weak, seen an expansion. I think the down move should continue. Deep targets on the downside is around 380 zones. Stop above 415 on Kedila should be fine. And another Indian Oil looks weak, seen a gap down open yesterday, maintained the gap down, can see a slide to 380, 375 zones, stop above 390.
Okay. Well, Mitesh, coming to you, I noticed that Bharat Forge again is a buy for you, but sells otherwise.
Yeah, that's the only buy call on the list, Lata. I think good swing breakout, good price and volume breakout, and despite the fact that the market is opening down, in case this opens gap down and recovers in the first 5 minutes, I would put in a long trade there. And we, of course, will have short ideas as well. So Bharat Forge is a buy with a stop at 743. Look for targets of 800. On the sell side, Adani Ports is a sell with a stop at 415, targets of 387. DCB Bank would sell with a stop at 173.5. Look for targets close to about 160. UBL, which hasn't really participated in the bounce back and in fact has turned negative, could see more weakness, so sell with a stop at 1080, look for targets of 1020. And Grasim, which has given a pullback and now is close to important supply zones, is a sell. Keep a stop at 1131, look for targets of 1065.
Ashwini, a follow-up on the HDFC Twins. Do you think the rally that we had yesterday gets sold into? Because there was quite a bit of weakness in both these stocks.
See, foreigners are selling. These are the two stocks they have in large quantities. Plus, they had those vertical rallies. They have given up some. But I think, you know, if an index has to fall 250 points, the biggest heavyweights have to fall. So I wouldn't be surprised if all banks come under pressure. See, banking had a very extraordinary rally in the last couple of months. A lot of it will be given back.
Okay, well,
okay, what would be the weakest link in the Nifty?
See, today the large stocks like Reliance, HDFC Twins, etc., ICICI Bank, they should all fall strongly because everywhere the trends are broken and you know, stocks are looking at going to lower levels. Mid cap, etc., are beaten out of shape. But these are the stocks where people were kind of hiding. So that's where you need the longs to come out of.
Let's move on from this technical talk. We'll come back for more, but it's a big day of earnings today. 7 Nifty companies will be announcing their numbers, and amongst them is the mighty SBI. Abhishek joins in to tell us what the street is expecting this time around. Abhishek, over to you.
Well, the key focus, Sonia, will be on slippages. Last quarter, it was at 10,600 odd crores. So anything below 11,000 crore will be positive. Some of the analysts like IDFC Securities is expecting a slippage of 14,000 crore. The improvement in the gross NPA, which was at around 9.83% in the previous quarter, will be very positive. They are also looking to, you know, have a shareholders not to raise about 8,800 crore of capital. That will be seen closely.
Abhishek, just hold on. I'm sorry to interrupt, but let's cut to network. Mohammad Appabhai is speaking to CNBC Asia.
And really the thing we're looking for is really an expression of the liquidity put. So we're looking for the central banks to step in again. It's not happening yet. There was an expression of the Kuroda put on Tuesday. It was really obvious around the time when the Nikkei broke below 21,150. But right now, we think what is happening is that people are moving from buying the dip. The risk managers are stepping in, taking over portfolios and asking for positions to be liquidated at a time when liquidity is very thin in terms of the ability to liquidate positions is really dried up in the markets in Hong Kong and right across Asia.
So, Mohammed, you know, interesting, the Kuroda put, because I wanted to talk to you about the Powell put, whether it actually exists, and do we have any evidence of that? I think that's one key question. But before I get to that, though, in terms of timing, when you get back into the market and use this as an opportunity, you're actually suggesting earlier in the curve. That is, if you see, let's say, 6% more downside on S&P to 2,400 or so, I get it, as opposed to Jonathan Garner, who's saying, look, wait until it starts moving back up and then climb on board. With your strategy, though, is there not the risk, this whole fear of catching a falling knife? Nobody wants to do that.
Well, at some point, somebody's got to catch that knife, otherwise you fall forever. So I think that, you know, we have to take a view, certainly from a trading side. I mean, certainly what we're advising our clients is this is where you know, at those levels, you'd be happy to roll down protection. I think what happens down there is you'd actually start seeing credit spreads widening out. So right now, it's very much equity related. We're concerned about volatility. And the volatility really started off in the foreign exchange market, moved to the rates market, then to the US equity market. Yesterday moved to European equities. Today is moving to Japanese equities. But the one place we haven't really seen this happening is really in the credit spreads. And we're quite concerned. We've got some indicators which are flashing at their highest levels since the 2012 European credit crisis, which indicates that credit here is a very good risk-reward from a short perspective, even against equities. So what we'd be looking to see is equities falling down to the regions that I mentioned earlier on. You'd start to see credit widening out. We think Fed fund futures for Jan 2019 actually are starting to look quite attractive. This is really what the market is concerned about, whether there really is a Powell put or not. And remember, every single time there's been a new Fed governor, the average fall in the market has been about 15%. So this is not something that we haven't seen before. It's just part of a pattern that goes back about 100 years.
All right, that's good precedent and also a good reminder. Now, let me ask you, what else do you need to see or would you want to see in terms of confirmation before it's, okay, now's the time to go back in? Talk to me about what you need to see or want to see on the VIX, what you want to see happening with U.S. yields as well.
Yeah, I think on the VIX, what there is really a measure of financial stress. So we're looking at some of our models that give us an equivalent, which seem to trigger at the same time when some of the Fed and the other central bank models trigger at the same time. And really what we're looking at is really this concept called the equity implied probability of default, i.e. when the equity market starts pricing in that everything is going horribly, horribly wrong. And also what happens is that the equity market has this reflexive feedback into the real economy, where the equity market falls actually start impacting the real economy. So if the markets don't hold up at the levels that we've been talking about, the probability of a recession really rises. I think what happens here is that we're probably fairly close to the highs on bond yields, in US 10-year bond yields, I think. And also, I think that the highs in the Hong Kong equity market and maybe in emerging markets are probably in for 2018. So it's sort of quite an early call on that, but we think people are trapped in their position, so every rally will be sold into. Certainly that's something that we are watching. So when people buy into it again, the preference is really still US, Japan, Europe, and probably EM at the bottom.
All right, Mohammed, before we get into get more into this whole buying in again thing, you were saying that you think that U.S. yields are fairly near the top. So what are we talking about here? Are we going to hit 3%? And the other thing is, I mean, let's say we break 3% in very short order, right? Maybe even overnight, who knows? We can pretty much take the wealth effect or negative wealth effect, what happens with stock markets, out of the equation, because north of 3%, you're talking very direct sort of correlation and impact on the real economy, on companies, on profits, on people.
Absolutely right, and this is what I'm really talking about the reflexive position. And remember that there's a lot of concavity in the, or convexity in the bond position. So, you know, a move from 2% to 3% is actually a very significant drop in the value of bonds. I think the other thing is that there's a lot of technical flow that is also going on here. I don't really think this market is being very fundamentally driven. It really is, you know, you have to look at things like the way that the volatility on treasury yields is, or on treasury bonds is moving. You have to look at the volatility in equity markets overall. And a lot of that is just causing people to reduce positions, not because they no longer believe in them, but basically because they're running out of risk budget. And I think the real key risk here is really portfolio managers losing sovereignty over their portfolios. But we're actually looking for that as an opportunity to buy into. When we get the liquidity put coming, basically what there is the potential for 6 weeks of choppiness. And then eventually we're actually calling for higher equity markets and higher bond markets probably over the next 6 to 12 months.
Wow. Okay. Stay right there, Mohammed. A lot more to come with Mohammed Apabai from Citi.
Oh, that's a very important voice. He says he sees higher equity and bond markets in the times to come, but in the very near term, he says that this could be, you know, a market that gets sold into. Also fairly close to the highs on US 10-year bond yields. That's an early call.
Yes, but the other thing he said about Hong Kong is that the highs of for the year have been made.
Yes.
Now, he didn't come to India, but, you know, we are going to get Mohammed on CNBC India as well. So just hold on. We'll take a quick break and come back and chat about those earnings, SBI and other banks. Welcome back. We have to talk numbers. On another day, we would have waxed eloquent on SBI. But today, we'll still have to attend to what you may expect. Sanjeev Bhasin of IIFL joins us now. Sanjeev, for me, the only scary part about the SBI numbers is they're announcing it after market hours. They don't normally do that.
Yeah, hi, Lata. So I think be prepared for a change in most global practices. You've seen a 10% correction in the Dow come in days. So I think SBI is cognizant of some risk which could come up. Okay. And I think that's why they are preluding to the afternoon session at 12 o'clock.
Okay. No, it's also a new chairman. But anyway, what are you expecting from the numbers? Again, I guess you will look at asset quality. What is the base that we should keep in mind when the numbers come?
So like I said, I think there can be some improvement in the asset quality given that GPAs may start to, dip a bit, and so could be the NPA. The real kicker would be the net interest income, because we've had bond yields give a good rise, and maybe treasury profit there is what I would be watching out for.
Profit?
Plus, I would also...
Treasury profit, Sanjeev?
Not treasury
Punjab
profit,
National Bank announced 1,100 crore treasury loss on bonds.
Exactly. So I'm saying treasury income is what we are going to watch for.
Fair enough.
I didn't say treasury profit. Treasury income is what we are going to watch for, because that will tell you what the net interest income is accruing on, and that's the way forward. Because bond yields at these levels is going to be the SBI will bear the brunt of it along with Bank of Baroda.
Sanjeev, good morning. I just want to talk about the numbers which are already out. For example, yesterday Bharat Forge and ACC. In this recent market weakness, do you think you would want to buy these stocks, or do you think that the market weakness will take a toll on all these good numbers as well?
So Anuj, it's a mixed bag. We've been very, very cautious, and we've not been so optimistic of this uptrend which has taken you non-stop. And we've been pointing out, from that 10,000 to 11,000, mid-caps were underperforming in a major way. Now, mid-caps are down 40% as a value investor. Even though ACC numbers seemed good, I would rather try and catch some of the mid-caps where I have more conviction and where there may be more money to be made in the near term. So yes, like you said, maybe the best of Bharat Forge and ACC is getting priced in. And cement, if I had to pick a pick, then Ultratech on declines would be my top pick.
What about some of these other non-index large caps, the likes of Page Industries, etc., that have been doing very well? Anything from that space that you like?
Yeah, so as a disclosure, Page Industry has been one of my, I own that, and I have been covering it all the way from 1,000 rupees, Sonia, and I continue to think that is it's a great value play, and I still think there's a 25% upside over a period of time. Notwithstanding that, it's not such a liquid stock. It's a blue chip, and secondly, these stocks will maybe not correct with the rest of the market. So the real pain is in the broader market, and the real opportunity is in the broader market where stocks are down 30-40%.
Okay. Well, Sanjeev, thank you very much. Results of the two big banks, BOB and State Bank, after market hours. So we will have occasion to invite experts like Sanjeev yet again to give you a reference point as to what you should expect on the numbers. And of course, our own Abhishek Kothari will be there. Take a break. We are coming back with pre-opening rates, and Mr. S. Pitulsan also will be joining in.